Joining us right now to talk about the markets, the economy, the Fed, and much more is Roger Altman. He is the founder and senior chairman of Evercore. And Roger, it's great to see you again.
Thanks for having me.
I think the last time we saw you was about a month ago. We have been watching the markets ever since, and it's had a lot thrown its direction to kind of push shares down potentially. It's managed to fight through a lot of that. How are you feeling about where things stand at this moment?
I just think the market is resilient. I mean, look at the headwinds it's shrugging off, the Iran war, energy costs, and now a little rise in interest rates, or a medium rise in interest rates. But I don't think those headwinds are enough to destabilize the market, because if you look at two things, the earnings growth, and I saw that 86% of the S&P 500 companies beat consensus, and there was another measure that it was the strongest quarter in 5 years. And then the underlying economy. I mean, Kevin Warsh's comments, which got very little attention on the economic strength, were striking. And you just look at below the 1.5% second quarter GDP number. Consumer spending was up 3.2%. There's a measure called final sales to private domestic consumers, up 3.9%. CapEx, very strong, centered around computer spending, but strong. And when you have consumer spending that strong and business investment that strong, I think it's a strong underpinning for the market. So I don't see the markets being destabilized by this move in interest rates.
A week and a half ago, we were talking about how sentiment had changed on Wall Street, and you were damned if you did, damned if you didn't when it came to AI, whether they were spending more on CapEx or spending less. The stocks were going down. There was a lot of panic around it. Was that really a change in sentiment, or was that just a case of one guy unloading a very leveraged portfolio?
Well, I don't know how to answer that last one, but there are two main points, I think, on this. One is you can't generalize about the companies. You know, Apple sank because of memory shortages and memory price increases. Microsoft rose and Amazon because of strong cloud services results. You know, very different factors.
But Alphabet sank the week before.
Yeah,
because of very similar situations where they were spending more on CapEx, but they've got a lot of demand in their cloud service too. If you looked at those reports, let's just say Microsoft, Amazon, and Google shares were down on that news. A week later, Amazon and Microsoft were up on that news. And that's kind of where we saw this talk about a change in sentiment.
Well, I just think it's hard to generalize. But second, I think the huge point is that no one really knows whether these astronomical amounts of spending on compute are going to earn a satisfactory return.
You're still nervous about that?
Well, I think everybody's nervous about that. I think AI is revolutionary myself. I mean, even more than a lot of people think.
Right.
And if I had to bet, I'd say there are going to be some big winners here. But there's a lot of concern over the amount of spending and whether it can earn a good return. And there's no way to know yet.
So, Roger, you think that the economy you just described, is it mostly AI? Is it only AI? What I'm getting at is, do you think you have to acknowledge maybe the big beautiful bill was good for expensing? And I mean, corporations are doing so well. The 1.5. If we hadn't imported as much to build the infrastructure, what would GDP have been? It would have been over 3, wouldn't it? Would it have been the 3.9 that you mentioned, or?
Well, I don't think AI spending is driving the whole economy. I mean, it's important, but I mean, if you look again just at the consumer side, and don't forget, 2/3 to 70% of the U.S. GDP is consumer spending.
So, what do you attribute that to? I mean,
I attribute it to some of the tax cuts that were in the bill.
Yeah.
The wealth effect, because such a high percentage of Americans participate directly or indirectly in the stock market.
Okay.
And shrugging off, $4.20 gas.
So that's the flying. The inflation is the only thing that really is the problem, which is a lot of it's based on the war. That's why Trump is so dead set on trying to get out of this thing.
And he should be. Yeah. But look, the U.S. economy is a marvel. Everybody travels around the world. Everybody, they may love American politics, they may dislike it. Everybody envies the U.S. economy. I mean, everybody. And for good reason.
Yeah.
So what do you think about what comes next with the Fed? Because generally, people will say what kills a market like that, it would be a Fed overly aggressive raising rates.
Well, first of all, I think Kevin Warsh is a smart guy. He's experienced in monetary policy. The press conference was a little off, I thought.
How so?
But, well, it's too jarring a change to provide no explanation as to why the FOMC held rates steady. Zero explanation. Because his predecessors, provided quite a bit of context and guidance. I think it was a little bit too black and white. And then second, he's obviously motivated or intent on saying generally a lot less across the board. And I think it's going to take the markets a while to get used to that. And third, I thought that particular comment on investors looking at the ball and not the referee was awkward because in the short end of the market, which is critical, the Fed is the ball, as Steve Leisman said. But I think he's very able. I think he's a real inflation hawk. And I know a lot of doubts about that because the Fed held rates steady. I doubt that. I think he's a true inflation hawk. And I think it'll turn out to be a blip. He'll figure out a way to, calm people down. And I'm very glad he's the Fed chair myself.
What do you think about the government's intervention with the yen? We were just talking about that.
Yeah, I know.
And how that has the potential to move markets down the road. How do you kind of lay that into your map?
Well, I'm no expert on the dollar-yen relationship and exactly what was occurring in that market. But it used to be the case that such coordinated intervention was common. The first time I served in the government, we intervened regularly. We intervened more than once in the Deutsche Mark and Swiss franc markets because of disorderly conditions. And I think if you're the finance minister, Bessent, you don't want to see real dislocations in currency markets. So I think based on what I know, it's a smart move. It's not a new move. It's an old playbook, used a lot in the past. So I think it was probably the right move at the right time.